What's up guys, welcome back to Money Crow, the channel all about making your money grow. In this video, I'll be explaining why attempting to time the market may be counterintuitive to a healthy investing strategy. But first, let's go over what exactly is timing the market. Timing the market means to make buying or selling decisions of financial assets by attempting to predict future market price movements. The prediction may be based on an outlook of market or economic conditions resulting from technical or fundamental analysis. So basically, if you see a chart like this one, you might be thinking to yourself, wow, the stock market is at the highest it's ever been. I think I'm gonna wait a little bit until the market drops before I buy in. But the issue with that form of thinking is that on average, the market tends to trend upward, and it often does so at a pretty fast velocity. That trajectory is very apparent if you examine this graph. And yes, of course, there are periods where the market dips, corrects, or even crashes, as you can see by what happened even recently in March. But over the long term, markets do continue to rise because productivity rises, inflation rises, and innovation occurs. These following graphics that I'm about to show you are my absolute favorite way of visualizing these types of topics. Jeremy with Personal Finance Club on Instagram does an amazing job at creating these visuals. So definitely shout out to him. We begin with a story of three friends who each save $200 per month with the plan to invest it in the S&P 500 for 41 years. So they each start in 1979 and they end in 2020. But each of them had different strategies about when to jump into the market. Now we see the actual chart of the S&P 500 over that 41-year time frame. We can see that many events caused severe downturns such as Black Tuesday, the Kuwait War, the dot-com crash, the financial crisis, and the recent crash in March of 2020. A chart like this can easily make even a seasoned investor feel uneasy and want to protect their capital and maybe not be so risky. Now let's look at how each of these three friends invested their $200 per month. Tiffany had terrible timing throughout her entire life. She parked her $200 per month in a savings account, earning 3% interest, always waiting for the perfect time to invest. And keep in mind, current high-yield savings accounts are paying around 0.5% today on average, with some of the best ones not even reaching 1%. So although that 3% rate that Tiffany was getting may have very well been the average, it's currently not what you can expect to get in a savings account. Tiffany had the world's worst market timing. She invested all of her savings into the market on the days right before the 4 biggest stock market crashes happened. But she never sold any of her stocks. So thanks to that fact, even with her terrible timing, she turned her $99,000 in principal that was added up from $200 a month for 41 years into a whopping $773,000. Even a very conservative and extremely unlucky investor like this came out with pretty massive gains. Now let's move on to Brittany. Brittany buys at the bottom of the market when stocks are at their absolute cheapest. Similar to Tiffany, she saves her $200 per month in a savings account earning 3% interest and waits for the absolute best times to buy when the market is done dropping. It turns out Brittany had the world's best market timing. She bought the day the market was the very lowest after each of the 4 biggest crashes. Her perfect timing earned her $1,123,000, which is $350,000 more than Tiffany earned. Now let's take a look at Sarah, slow and steady Sarah. She didn't have much interest in watching the market or trading, and in fact, she only did one thing. On the day she opened her account in 1979, she set up a $200 per month automatic investment into an index fund and never looked at her account again. Her account grew to an enormous $1,620,000, which is $847,000 better than Tiffany. That's over 2 times better than Tiffany, and $497,000 better than Brittany, so almost $500,000 better than her. Which, remember, accomplished an absolutely incredible feat of being able to pick the exact bottom of the market every single time. The moral of that story is to invest early and often. As Warren Buffett likes to say, time in the market beats timing the market. Another moral, though, is that you don't have to invest all the time, and you don't even have to be lucky when you do invest. but the fact that you're investing and buying and holding will reward you immensely over the long term. Before we continue, I just want to give a quick shout out to my amazing Patreon supporters. We have our standalone Crow CEO, Jorge Ledesma, and our 4 Crow investors, Prismatic, Erica, Andrew Paz, and John Harden. Thank you all so much for your continued support. If you guys are new to the channel and you want to be notified immediately after I make a trade in my $100,000 portfolio, please consider supporting the channel on Patreon. I always post all my trades on there, so you'll be the first to see them. Link is down below. Another easy way to help out the channel is by clicking my 3 different referral links so we can both get free stocks and free cash. For a limited time, Webull is giving away 4 free stocks, M1 Finance is giving away $10 in cash, and Robinhood is giving away a free stock like Apple or Facebook or many others when you sign up. Links are all down below in the description. Thank you guys. I found this article by The Simple Dollar, which explains why mistiming the market can be disastrous. This graph shows what would happen to $10,000 invested in the S&P 500 from 1980 to 2018 if you missed some of the best days in the market. If you were invested every single day, your $10,000 would have grown to over $708,000. However, by just missing the best 5 days, that cuts down your total all the way down to $458,000, which is insane to think about. Just 5 days when we're talking about a 38-year period. 38 years times 365 days per year equals 13,870 total days. I don't know about you guys, but this blows my mind. That all you had to do was miss those best 5 days, which obviously you don't know which days are going to be the best days, and your returns are cut dramatically. And you can see how your returns keep getting worse and worse and worse the more of those best days in the market that you miss. For me, this is the #1 biggest motivator to buy and hold and never ever sell during the accumulation phase. It's just so improbable that you're going to be successful timing the market. Why risk being that person that misses the 50 best days and returns only $62,000 when you could have had $708,000? And of course, when those numbers start getting larger, the potential losses start getting larger as well. The article goes on to say that another good reason to stay invested is that the majority of the best stock market days throughout history have come in the midst of significant market downturns. Of the top 10 biggest gaining days, 6 of those occurred during the chaos of the early 2000s .com tech bust and also during the 2008 Great Recession. So if you didn't have your money invested during those turbulent times, you would have missed 6 of those best days. Here's research done by Charles Schwab that shows how missing the best days in 2009, which was an exceptionally volatile year, would result in missing out on huge potential gains. Just missing the top 10 days results in having $43,000 less than if you just stayed invested the whole time. To me, that's just absolutely crazy. In this same article, Charles Schwab allows us to build a portfolio based on risk tolerance. For this first example, I went 100% stocks. We can see that most years result in a huge upward movement, with only a few years resulting in large downward movements. Notably, in 2008, the worst year, results in negative 37%, which would make anyone's stomach churn if their entire life savings were down by 37%. But looking at an all-time chart of the stock market, you can see that even that huge drop is just a small blip on the large-scale timeline. But even if that isn't enough to reduce your fear, simply add more cash or bonds or both to your portfolio to be able to withstand market downturns more easily. We can see that by just adding a small 10% bonds and 10% cash allocation to our portfolio, we're still able to earn 32.5% during the best year, which was 1995, but now we only dropped 28.9% during the worst year, 2008. If you guys enjoy this type of content, I would really appreciate it if you like the video and subscribe to the channel. It helps me out a lot. Thank you guys so much. Here's even more research by Charles Schwab, which backs up all the other data we've gone through in this video. They show how even bad market timing trumps inertia. In other words, invest early and often. They looked at a time period from 1993 to 2012. Each of these strategies is being simulated by each person executing those strategies, receiving $2,000 at the beginning of every year for 20 years. Perfect timing meant this person invested their $2,000 during the absolute lowest point of the stock market each and every year for 20 years. Investing immediately meant that this person invested their $2,000 right away every year on January 1st of every single year. Dollar cost averaging meant that this person split up their $2,000 and invested it in 12 equal portions each and every month, so about $166 per month. And bad market timing meant this person invested their $2,000 during the absolute highest point of the market each and every year. Stay in cash investments meant that this person took no risk in the stock market and only invested in extremely safe assets like savings accounts, certificates of deposit, and treasury bills, things like that. We can see that every single strategy except staying in cash investments performed wonderfully and surprisingly without too much difference in results, even when comparing the worst market timer to the perfect market timer. Another article I found by indexfundadvisors.com reveals more evidence as to why market timing doesn't work. The findings show that massive returns typically occur after a significant decline in the market. This chart specifically identifies the top epidemics that have occurred. Just look at those following 12-month returns, and again, look at how the chart trends upward over the long term and makes these events look like a minor inconvenience or arguably great buying opportunities on a long enough time frame. This next graphic shows how similar good returns followed other significant catastrophes that affected the stock market. You can see by this data how markets tend to trend upward and they rebound pretty quickly after suffering a decline. But now for a minute, let's take a look at the allure of market timing, which obviously means to miss the worst days in the market. They found that from 2000 to 2019, investing $10,000 and remaining fully invested in the market for all 5,035 days resulted in an annualized return of 6.02%, with an ending value of $32,192. However, if you were somehow talented enough, or more likely lucky enough, to miss the 40 days with the biggest losses, your $10,000 instead grows to $252,000. That would make anyone want to try to time the market, right? The problem is that it's almost impossible to do so, and even if you get lucky a few times, it's so improbable that you'll get lucky consistently over the long term. But again, now let's look at missing the best days in that same scenario. If you miss the best 40 days, your return becomes negative. That's crazy to me. Your $10,000 turns into $4,615, losing more than half its value. I don't know about you guys, but I'd rather just take that $32,000 return and not stress about jumping in and out of the market and potentially miss out on enormous stock market gains. I really hope I've helped show you the evidence that supports investing early and often, and to never sell during your accumulation phase. Thank you guys so much for watching until the very end. I hope you'll be back for future videos, and as always, please subscribe, hit the notification bell, like, and comment. Have a great day, and I'll see you guys next time.